So what is the basic premise of a treasury company? Well, it's very simple. You have a block of digital capital, raw digital energy. Here, it's commodity. The world doesn't want it. What the world wants is a set of securities, either credit instruments or equity instruments or derivatives that meet their requirements. The analogy I've used before is Standard Oil. Think of a refinery. I have a block of raw liquid energy. Einstein said matter and energy, they're interchangeable. I have raw liquid energy in the form of a barrel of crude oil. The first application was kerosene. Kerosene is jet fuel. Kerosene lights up your house. Kerosene was light. Kerosene is rocket fuel. You can't light up your house with a barrel of crude oil. You can't fly a jet with a barrel of crude oil. So we needed kerosene. We refine it. We mark it up. But there's gasoline, there's diesel, there's asphalt. And then if you actually go on an AI and say, tell me all the specialty chemicals of crude oil, there's also lycra, there's also acrylic, there's also plexiglass, there's PVC piping, your lubricants, you know, every form of plastic, stuff you eat, nylon, polyester, right? It goes on and on. We build the houses, we turn the machines, you know, we look through these things, and they're all products, right? So I can refine it to be a different form of energy, whether it's kerosene or gasoline or diesel, or I can create lycra, or I can create plexiglass, right? And so products, services, forms of energy come from that barrel of crude oil. How big is that? Well, I mean, just think about, at some point, Standard Oil also owned half the gas stations. So you've got gas stations, you've got every type of energy, and then you've got DuPont, and you've got everything that every chemical company ever created. And look at the stuff you're wearing, probably. You're wearing stuff that came out of a barrel of crude oil, right? It's the stuff that's in your tennis shoes, right? So it's not a difficult stretch to say, oh yeah, in the first year when John D. Rockefeller, maybe 1865, when he started screwing around with a barrel of crude oil and out came some kerosene, a lot of haters said, well, there's no future to this industry, right? And of course the industry today is, what, a third of everything. Now let's take that digital energy. What is the role of Bitcoin? You know, we say Bitcoin miners, they recycle stranded electricity or stranded energy. Well, Bitcoin Treasury Companies recycle stranded capital. Okay, more than half the capital, 2/3 of the capital is locked up in structured institutions right now. It's capital sitting in a bank, in a pension fund, an insurance fund, and a retirement account, and an institutional investment fund, and an index fund. In a money market fund, right? They're all locked up, the great majority of this capital. And they're in certain places. So what do they want? Well, you know, the insurance companies and the pension funds, they want long duration yield, right? That's what they want. The money markets, they want this very short duration liquidity credit spread. Everybody wants something different. The equity investors want leverage on some underlying business model. The derivative investors want that. Now, if you think about, you know, think about the process of creating a piece of digital credit. What I think in my mind is, this is a block of plexiglass, or this is a block of acrylic. Just think like a big block of plastic that's a meter by a meter by a meter. And then I have a CAD/CAM system and a computer-generated machining, a machine that's computer controlled, so I can operate the lathe and I can chip out anything I want from that block of plastic. So I put in whatever my image is, I unleash the computerized machine, and I get out some beautiful sculpture, right? Not quite 3D printing, but something like that. I'm converting a block of raw material into something, a beautiful work of art. And of course, what does the person want to see? How many different types of sculptures? There's infinite types of sculptures, and they're all just coming from a single block of some kind of acrylic or plastic. Now, I think about digital capital. It's like you have a bunch of digital capital. You have $1 billion of Bitcoin on your balance sheet. You can carve out any digital credit instrument you want, right? And credit instruments are very, what's the degree of collateralization? Is it 10x over collateralized? What's the degree of liquidity? What's the credit guarantee? Can I get my money back in a year, in a decade, in a century? Is it perpetual? What kind of yield does it give me? What's the yield curve? Is it high duration yield? Here's the magic trick, right? You're a Japanese company. You want to create 5% yen, 5% yield in yen forever. How do I create that, right? Is there a market for that? Yes, there's like trillions of dollars of money markets in yen that get 50 basis points. So if I can carve out 500 basis points and I create this currency, I'm going to take the currency risk of the yen. I'm going to create this yield. I'm going to actually create duration forever. And what's the collateralization? Do you want 10 over collateralized or 5 or 2? What kind of credit risk is going to be embedded in this instrument? I can actually sell you that instrument and I can collateralize it 27-to-1. I can collateralize it 20-to-7-1 and give you a credit put, every 3 years, and I can completely change the nature of the credit. Or I can collateralize it 2-for-1. I can create sub-junk yield, right? And I can give you a different instrument. So when it comes to credit, you've got all sorts of investors. The Russians don't want US credit. The Chinese don't want US credit. The Japanese don't want US credit. The Canadians, the Europeans, they don't want to take credit. They don't take currency risk. So you can create a credit instrument, if you're a Bitcoin Treasury company, in any currency, with any degree of duration, with any degree of collateralization, with any degree of volatility. I talked to a guy probably richer than everybody in this room, and he's got a bit of Bitcoin, and someone says, well, why do you only have like 1-2% of your portfolio in Bitcoin? He says, well, frankly, I'm like something years old, and I can't handle the vol. Okay? 75-year-old, 80-year-old guy with a lot of money, he just doesn't want a 50 vol, 50 ARR instrument that you have to hold for, if you call it indefinite duration, in theory it's 120 months. So if you're willing to hold this thing for 10 years, somewhere between 120 and 240 months, I'm pretty confident you get yourself like 30% a year ARR. But when you're 92 years old, who wants to actually hold something for the next 25 years? They don't want it. And so there are a lot of people, there are very wealthy pockets, and they can't stand the duration. They can't handle the volatility. Another example of people can't take the vol, corporate treasurer. You've got a Bitcoin company, you believe in Bitcoin, but you got to make payroll and you need to make your rent. And so you have working capital. Conventional wisdom is keep 1 year of working capital into the currency that your liabilities are denominated in. That's your treasury. You're not going to put that in Bitcoin. You're going to put that in, right now you're going to put it in a money market, and in the US it'll give you about 3% after tax. But in Japan, it's going to give you 25 basis points after tax. In Switzerland, it's going to give you minus 50 basis points. The entire yield curve in Switzerland is negative out to 4 years. In Europe, it's going to be 200 basis points, maybe. So you've got how much? 30, 40, 50 trillion dollars tied up in treasury instruments and money markets and the like between Japan, Europe, Switzerland, Canada, the US. 30 trillion in the US alone. They can't stand the vol. They want you to strip the vol. They want you to strip the interest or the yield duration off the instrument. Just give them pure spread. So what is the closest thing to kerosene that we can produce in this industry? It's basically pure yield. Something like we created with Stretch, it's like if you can just strip away the current, I live in Japan, and I like the 400 basis point treasury, but I can't stand the US dollar risk. I can't stand the currency risk. Strip away the currency risk, strip away the duration risk, strip away the volatility, strip away the credit risk, give me liquidity, right? Serve it up to me in some sort of credit instrument. And, take Metaplanet, they're sitting on billions of dollars of Bitcoin. If they can open up the credit side of that trade and they can sell Meta yield at 5 or 6% in JPY, they'll be arbitraging 50% US dollar ARR versus 5% in the yen, and they capture the 45% spread, right? Which is, to say they're getting 90% of the economic gain is an understatement. They're getting 100% of the economic gain up front. They're getting 90% in the first increment, compounding exponentially. So when you set up that instrument, you're getting like 95% of the economics, right? And so when you think about what is the opportunity here, everywhere in the world, you need treasury companies. Why? Because you're creating the high-quality credit. And what credit? Well, you can create that pure yield product, and you can sell it direct retail, go to the retail, like sort of we're doing. You could also create that product and partner with the largest bank in Switzerland, and you could power their treasury. Well, B of A is running treasury for $1 trillion or something. So what if you actually power the treasury of another bank and you become a B2B player? So a company could pursue a strategy where they create the yield and they create the return or the credit instrument, but they sell it through a bank. Well, how many banks are there? 25,000 banks. There's 25,000 people to sell it to. Well, what else? Insurance companies and annuity companies. There's companies that have hundreds of billions of dollars, and they're on the hook for annuities. Open up a pipe to the annuity company or the pension fund, and you just sell the yield directly through. You could do that as well. Also, the insurance business, right? And so when I look at this, people go, well, how much room is there for Bitcoin Treasury companies? That's like, some dude says, why would you want to buy a hamburger on the Upper East Side for 40 bucks when I'll sell you a hamburger for $3 in Kansas? Well, because I don't live in Kansas. That's not, okay, well, so I guess there's room for one restaurant in New York. Well, what about the people downtown? What about the people who live in Tokyo that want to eat, right? The truth is there's a lot of room for restaurants. There's a lot of room for, how many banks? 5,000 banks in the US. There are 25,000 banks in the US 80 years ago or 100 years ago. So 100 years after they're obsolete, there's still 5,000 of them, right? There will be thousands and thousands of treasury companies. Just like there's thousands of insurance companies, thousands of funds, thousands of banks. And why will they exist? They will exist because the risk-free fiat credit rate is 50 basis points in Japan and minus 50 basis points in Switzerland and 200 basis points in Europe and 400 basis points in the US, going to 300 basis points soon. And the world wants 10%, right? And who wants 10%? Everybody. Okay, so the real issue is, how are you going to wrap it? How are you going to construct it? I want it to run on my rails. You can buy Stretch on a NASDAQ brokerage, but you can't buy Stretch on Robinhood. Okay? How do you get the security to go down the rail? It's kind of like, yeah, I got a hamburger, it's $3, but how do I buy it in London when the hamburger is getting served up in San Francisco?